Hey, welcome to the 40 Finance channel, everybody. My name's Jeff Beers. Today we're going to take a little bit of a contrarian view on this inflation that's going on right now. And we're going to talk about the probability that inflation has actually peaked here in 2022. And while that doesn't mean that it is over, we have seen the largest increases for the year. Okay, so the premise of this video today is based on this article by UBS Wealth Management. Inflation may now have passed the peak. This was written on April 13th. And let's dig in and see what the rationale is here. This is the thought of the day from UBS. U.S. consumer price inflation climbed 8.5% in March compared to a year earlier, its highest reading since 1981 and above consensus forecasts from economists. On a month-on-month basis, it accelerated 1.2%, the highest rate since 2005. There were also signs of pressures broadening. The Cleveland Fed's trimmed mean, which strips out price moves at both extremes, climbed above 6% for the first time since the series was launched almost 4 decades ago. The Atlanta's Fed measure of sticky prices, ones that are difficult to unwind, rose to its highest level in 3 decades. All right, and even more here. The data was accompanied by further hawkish commentary from St. Louis Fed President James Bullard, who said it was a fantasy to imagine that inflation could be brought down to acceptable levels without hiking interest rates to levels that would constrain economic growth. Governor Christopher Waller on Monday noted that interest rates are a brute force tool, and there will be some collateral damage when hikes are used to slow inflation. So right off the bat there, we got some strong data points and strong quotes that suggest there's no way inflation gets under control without severe interest rate hikes. And if we have severe interest rate hikes, then of course we're going to have collateral damage. And that collateral damage, I think that most people are referring to, is of course the returns in the stock market. All right, so in those first 3 paragraphs in this article, I would say that they've essentially captured the predominant feeling that I see on television, CNBC, Twitter, all these folks that are seemingly infatuated with the prospect of inflation, going to the moon and stocks getting destroyed. But what are some of the contrarian indicators, right? Because, obviously, this article's title, Inflation May Now Have Passed the Peak, isn't written to talk about why inflation is going to go up. So they share a few things here. Beneath the headlines, there were also indicators that inflation is starting to moderate. So let's see what those are. There were signs that pandemic-related price distortions are starting to fade, with price rises in certain goods moderating or even declining. Investors appeared encouraged enough by the core CPI, excluding food and energy, which rose 0.3% month on month in March, the slowest rate since December. So you take out food and energy, which sounds a little ridiculous, but it's actually the way most economists measure inflation, because there's a lot of different pressures on food and energy that make their prices a little bit more all over the map, if you will. It's not so much a consistent gain or loss with food and energy. And yet, oddly enough, a lot of people lump food and energy into the number one ways that they can identify that inflation is taking shape. So it's sort of an economist view versus street view. All right, the news was even better on core goods, which were boosted by a surge in demand during the pandemic, with a decline of 0.6%, the first decrease since February of 2021. Used car prices, which have soared, fell by 3.8% month on month, and there were also declines in some electronic goods, including televisions and smartphones. Now, just to be fair, they did call out service sector inflation was less encouraging. Part of the upward pressure came from a 10.7% month-on-month rise in airline fares, reflecting higher fuel costs. So airfare prices, in my opinion, are kind of interesting to think about in this current environment, because you kind of have all this talk about inflation, but then you also have higher fuel costs. And in general, if you have higher fuel costs, then airfare typically goes up. So once again, from like an economist view, you're not going to say that airline ticket prices went up because of inflation. The core reason is they went up because of gas prices. Some people think that's inflation, but in a lot of ways, it's a supply and demand thing. All right, let's move on here. Base effects look set to slow the pace of inflation. Although we expect crude oil prices to end the year around $10 a barrel higher than at present at USD $115, our view is that the recent rise in oil prices should moderate. Barring another surge, comparisons with last year should lead to lower inflation readings over the coming months. More broadly, investors should be aware that the latest data compares a normal economy to a pandemic-suppressed one. By April, the data will be comparing a normal economy to one that was reopening and in which prices had already started going up. By the summer, we should expect to be comparing a normal economy to a relatively normal economy in 2021. As a result, inflation readings should be less concerning. And if anything else, those statements make a lot of sense in terms of the year-over-year comps on inflation, because we do have some very weird comps right now between March of this year and the stuff that's going on in the world versus March of last year. And if you assume on the positive side that things like supply chain, war, China closures, if you assume that those things get at least a little bit better by the time we get through into summer, then you will start to absolutely see that the inflation numbers versus the year before, it's not going to be 8.5% like it was in March, right? All right, one more point here. Rapid wage increases are being accompanied by higher productivity, muting the inflationary effect of more generous pay. Atlanta Fed wage tracker is running at 6% on a 3-month rolling average for March, the highest rate in the history of the series. But wage rises are only inflationary if they are not matched by higher productivity. In fact, we are seeing higher productivity. So the 0.9% annual rise in unit labor costs in the United States for the fourth quarter was in line with the past 2 decades. So the point there is that labor costs as a percentage of productivity are actually on pace with other years that we've seen in the past. So while it might seem odd, perhaps that a warehouse worker was making $12 an hour in 2018 or something, and now they're making $20 an hour, which is obviously a huge increase. Across the board, when you factor in millions and millions of companies and workers, it's actually in line with some of the increases that we've seen in the past. All right, and to summarize here, while consumer spending is being eroded, we believe recent inflation data has overstated the hit by, for example, failing to reflect the reduction in mortgage servicing costs, as many homeowners have refinanced at lower rates in recent years. And while the pace at which inflation will moderate is uncertain, our base case remains that a recession can be avoided. Against this background, while we are neutral on equities overall, we continue to see areas of value, including long-term themes such as 5G, smart mobility, and automation. So UBS didn't finish their article by saying, we think inflation is overstated, but just in case, go buy a bunch of commodities. Instead, they came out and said, we're neutral overall on stocks at this current period, but if we do see our thesis start to take shape and inflation moderate, some very intriguing investment opportunities in things such as 5G, smart mobility, and automation. All right, now let's flip over to another blog post on UBS, this one by Paul Donovan, titled Team Transitory, obviously referring to transitory inflation, which has turned into a big joke out in meme world. But Paul Donovan is actually supporting the concept, and let's see what kind of bullet points he gives. This is just more like a daily update blog. It's not a full-blown article. Economists regard transitory inflation as lasting 12 months. Politicians expect transitory inflation to last 12 weeks. Yesterday's CPI data supported economists' views, with inflation slowing or moving into deflation where it was expected. Goods where demand is normalizing. Service sector inflation was mainly a commodity price disguised as a service, namely airfares. So remember, I called out that service sector 10% increase on the previous articles. Mostly airfares, which we also discussed as being tied very specifically to higher oil costs. All right, now, if you're curious where UBS sits in terms of their estimates, it's reflected here in this graph in a partnership they did with Fortune. The brown columns are the estimates going forward. And we have March that just came in at 8.5%, which they obviously nailed. Then they got 8% for next month. And as we scroll down, we talked about July. Perhaps in October, we start to hit below 5%. And then certainly into holiday shopping season, if these projections hold up, we would get under 4%. And the big takeaway for me when you look at this as a whole is not so much that the numbers are awesome, right? In the sense that 8% is still a hit to the bottom line. Particularly for consumers, but every time these reports come out, if you think about it that way, if you think about the press release for when these reports come out, right? This month, peak inflation 8.5%. Well, next month, when the April one comes out, they're going to say inflation is down to 8%. And then we keep going. And then you start to get in July and they'll start to say, you know, inflation down for the fourth month in a row, now getting under 6% or some version like that. So you can understand how the power of positive momentum could come into play as we enter the second half of the year. And if you've been watching the channel, you know that that's really been my take, right? It is just the second half of the year. This is peak disaster time or peak, bearish time. And I think that things get better. We have a huge earnings season coming up, and that's where it's going to be interesting to see how the other CEOs project, not only the next quarter, but the rest of the fiscal year. The worst case scenario, obviously, there is a bunch of CEOs come out and say the rest of the year is not looking good. All right, guys, so that's a contrarian view on the old inflation is going to ruin us all popular opinion that's floating out right now. I tend to stand with UBS, just reading through the research and some of the points they made. I'm not smart enough to make that research myself, but I can certainly read it and agree with it or not agree with it. And I've chosen to agree with it, at least for now. But let me know what you guys think about inflation in the comments below. Are you on the UBS side, that we're going downhill from here, or do you think the worst is still yet to come? And before you go, make sure you check out the description for a special offer on 1 year of Seeking Alpha Premiums, a service I love and use all the time. All right, guys, thanks for watching. Please give the video a thumbs up. I really appreciate your support. We'll see you on the next video.